Hello everyone, and welcome to TLA. In this episode, we will explain how to use trend lines like a professional trader, including our advanced trendline trading strategies and techniques. So, if that is something you are interested in, be sure to like, subscribe to our channel, and hit the notification bell to know exactly when we release new content. Also, drop a comment below. See you right after the intro and disclaimer. And tell us which topic you'd like us to cover, since we review them to decide what to present next. So first, what is a trend line? A trend line is a line that connects the swing highs and swing lows in a trending market. Here, we have a clear uptrend, an impulsive move followed by a corrective move, then impulsive, corrective, and so on. At the top of each impulsive move, before the corrective begins, we call this a swing high. At the bottom of each corrective move, before an impulsive starts, we call this a swing low. This means that in a clear uptrend, the price will form higher highs and higher lows. Now, a trend line is drawn to connect the swing lows along the bottom and the swing highs along the top. So, let's move on to a downtrend. Here, we have a clear downtrend, an impulsive move, then a corrective move, impulsive, corrective, and so on. At the bottom of each impulsive move, before the corrective begins, this is called a swing low. At the top of each corrective move, before the impulsive begins, this is called a swing high. In a clear downtrend, the price will create lower lows and lower highs. Now, a trend line is drawn to connect the swing highs along the top and the swing lows along the bottom. Here's an important point. Price won't always move this smoothly in trending markets, but we show it this way as an indication of what a clean trending market looks like. So, why do we even draw trend lines? The first reason is that trend lines can act as support or resistance. At the top, the trend line acted as resistance when the price reached it, and along the bottom, notice how the trend line acted as support. Here's another key point. We don't enter trades just because price touches a trend line, even if it acts as support or resistance. We always wait for price action entries in combination with other factors, which we will explain later in this video. The second reason we draw trend lines is that breaking a trend line can signal a potential trend change. For example, at the top, we had an uptrend for a while with our trend line placed along the bottom. Once the price broke this trend line, it shifted from an uptrend to a downtrend. Again, once the downtrend began, we placed a trend line above the swing highs, and when the price broke this line, it shifted from a downtrend to an uptrend. Now, here's an important point. We don't enter a trade just because the trend line has been broken. We always combine this with price action techniques and wait for entry signals, which we will explain later in this video. So, now that we understand what trend lines are and why we apply them to our charts, let's go over how to draw trend lines properly. First, let's begin with the concepts we follow when drawing trend lines. First, obvious trend lines are better. Look for a trend line that is clear and easy to draw, because it means more traders are watching it. Second, more touches, the better. Multiple touches add strength, but it does not guarantee the line will hold the next time. Third, trend lines are areas, not solid lines. Just like support and resistance, treat them as zones, not a single price point. Fourth, never force a trend line. Use them as guidance for your overall analysis, not as a strict rule. Now that you know the concepts of trend lines, let me show you how to draw them properly. Here's a common question we often get. Do you draw your trend line through the candle closes or the wicks? The answer is simple. Draw the trend line where you can achieve the greatest number of touches. Candle bodies or wicks don't matter. For example, here was a clear downtrend, and to hit all these points, this is where you could have placed your trend line. Notice how, in some cases, the trend line touches the wicks, in others it connects with the candle bodies, and in some places, there are no touches at all, which is perfectly fine. The same applies along the bottom. This is how we would place the trend line to capture the maximum number of touches possible. Once again, in some places, the trend line touches the wicks, in others the candle bodies, and some cannot be reached. Here's an important point. As swing highs and swing lows shift over time, adjusting the trend line to the most suitable position is completely fine, because we use trend lines as guidance and treat them as an area, not a strict solid line. Now that you know what trend lines are and how to draw them, let's move into the strategies of using them in combination with price action. But before we continue, if you're feeling generous, please hit the thumbs up and subscribe buttons to motivate us to create more videos more often. Also, comment below with your questions and thoughts. We'll do our best to answer them and make videos around your requests. So, we combine trend lines with price action in two main ways. First, we have the trend continuation trading strategy, and second, we have the reversal trading strategy. Let's begin with the first one, the trend continuation strategy using trend lines. Let's break it down step by step, starting with how we read the market structure and price action. In this example, we only use one time frame to explain things, which is the daily time frame. Later in this video, we'll show you how to apply multiple time frames. First, it is clear that this is a moving downtrend, as the price is creating lower lows and lower highs, so we want to trade in the same direction with the downtrend. Second, we connect these 3 points and draw the trend line, remembering to stretch it further in case price pulls back to it. Third, if we look left, we can see the support level turned resistance here, and we have it drawn. Fourth, we've identified this zone where support and resistance intersect with the trend line. This level is what we call an area of high convergence. An area of high convergence is where multiple price action concepts align, making it an optimal trading zone for high probability setups. This means that many traders are focused on this area, and there is a higher probability they will take action when trade opportunities appear. Let me explain why this area is considered high convergence. Because a lot of traders are watching it to place trades based on support and resistance, trend line, price action, and candlestick signals, or the confluence opportunity. All of these traders, with different trading styles, observe this zone for possible short entries. So, when price approaches this level, since we already marked it, we wait to see how price reacts once it reaches here in terms of price action. Now, this is what goes through our minds. We won't enter a short trade immediately once price touches this key level. No matter how strong an area looks, we never enter blindly. We always wait for price action signals, because price can just as easily break through. Notice how the market reacted to this area by printing an engulfing candlestick, rejecting downward instead of breaking higher. At this point, you could have made an aggressive entry here, but still, we would not take the trade yet, because a reaction at an area does not always mean reversal. Remember, this is still a moving uptrend on the lower time frames. Here's the key point. To enter a trade after rejection at a key convergence area, you place a trend line under the secondary moving trend and wait for a break of the trend line to confirm the uptrend is over and the primary downtrend can continue. This is a fundamental concept to grasp. Even though your primary trend is a downtrend, your secondary trend is an uptrend. The moving uptrend could continue, break resistance, and cause a major trend change. That's why the short-term trend needed to be overturned by a trend line break so the long-term trend could continue. Another important point here is that the break of the short-term trend line happened after the rejection from the resistance area. Otherwise, it would have just been a short-term trend line break with no context. This distinction is crucial, so let's recap to highlight the points. First, our primary trend was a downtrend, giving us a big picture bearish bias. The problem was that the short-term trend was an uptrend, meaning price was moving with bullish momentum and could easily break through the long-term trend line. That's why we needed bearish price action to appear inside the short-term uptrend, so the short-term trend would align with the long-term bearish trend. Our bearish signals then came in two parts. First, a reaction at the resistance area of high convergence. More importantly, this was confirmed by the break of the short-term trend line. At that moment, the short-term trend turned bearish to match the big picture downtrend, giving us the confirmation to trade. You could have taken the entry on the trend line break as a momentum play, or by using any other strategies once your directional bias was confirmed as short or down. Now, here's where we advance our trading to the next level. We zoom into the lower time frames, analyzing price action just as we did here, so we could have taken an even earlier entry, which we will cover next. So, let's move to that. In this example, we will show you the same concept but take it a step further by applying it to multiple time frames. Here, we are looking at the daily time frame. First, we identify that this is a moving downtrend, as price is making lower lows and lower highs. Therefore, we want to trade in the same direction with the moving downtrend. Second, we connect these 3 points and draw the trend line, stretching it further in case price pulls back to it. Third, if we look left, we can see this interesting area here, a key level of structure with multiple rejections that can now act as resistance. Fourth, we've identified an area of high convergence, where this major structure level crosses the trend line. Now, as price approached this zone, we had no way of knowing whether it would break through or reverse. Because once again, although your big picture trend is bearish and in a downtrend, your short-term trend is bullish and in an uptrend. This creates a conflict in your directional bias. To resolve this, you must wait for bearish price action to print after hitting the area of convergence, confirming that the short-term trend is finished and price can now continue moving downward. Otherwise, there is no trade. In this case, we zoom into lower time frames to study price action in more detail, allowing for a more precise and earlier entry. So, here we have the 4-hour time frame. We can see the same resistance level from the daily chart and the same trend line from the daily chart. On the daily, you couldn't see much detail, but on the 4-hour, you can clearly see the swings inside the short-term uptrend and the price action as it reaches the area of high convergence. At this point, there are several ways to enter the market. One option would be placing a tight short-term trend line below the secondary uptrend, and once price broke through that line, it could serve as our short entry signal. Another option is noticing that once price reached this zone, it formed a double top, which is one of our favorite reversal chart patterns. An aggressive entry could have been taking a short trade immediately after the engulfing momentum candlestick, which was also the second touch of the double top. A more conservative entry would have been waiting for the double top to complete by breaking the neckline to the downside. Again, there are many possible entries, but the key point is that all of this happened after the rejection and bounce from an area of high convergence. Without that, it would have been nothing more than a simple break and retest. Another important point is that trend continuation strategies are not limited to these time frames. You can apply them to any of them. But remember, the setups you find on higher time frames carry more weight. So now that you understand how to use trend lines for trend continuation trading, let's move on to the second way of using trend lines, which is through reversal trading. In this section, we will explain the reversal trading strategy with trend lines. But before we begin, if you're enjoying the content so far, please give this video a thumbs up and click the subscribe button to watch more videos like this. Now, let's break down the analysis step by step on the 4-hour time frame. Here, we clearly see a moving downtrend. First, we identify our trend line through these points. From this, we can establish that the trend line has been broken, and the trend could reverse from here. The problem, however, is that a trend line break can often be a fake out. So, what we do is look for key price action reversal patterns that form right before a trend line break. There are many types of reversal patterns to watch for, such as double tops, double bottoms, head and shoulders, triangles, and so on. The reason we want to identify a reversal pattern before a trend line break is that we are going against the dominant trend. In this case, the price action pattern we observed was a double bottom. What does the double bottom tell us in terms of price action? It shows that price failed to create a lower low, which signals a loss of momentum. Now, in the second step, we identify this key level that has acted as both support and resistance. Third, we mark this area of high convergence where the key level and the back of the trend line intersect. With our optimal trading zone now identified, let's move into the lower time frame. To have a more precise and early entry now here in the 1-hour time frame, we can observe much more detail once the price gets to the area of high convergence. Again, you could place a trade with many entry strategies, but for us, breaking above this consolidation area would make a great opportunity to enter the market. So remember, combining all of our analysis, including reversal pattern, trend line break, and identifying the key level of structure, made this entry to high quality trade. Increasing trade quality is also knowing when not to take trades, which is just as important as knowing when to take trades. Thank you for watching. So, if you want to learn more about our trade entry strategies, make sure to subscribe to our channel. If you enjoyed this video, please give it a thumbs up to support us in creating more videos more frequently. Also, comment below